What's up, everyone? It's Sayed, and today, we're talking about investing. Specifically, we're tackling the age-old question, mutual funds versus the stock market. Which one is right for you? Now look, I get it. Investing can seem super intimidating, especially when you're first starting. You hear all these terms like diversification, portfolio optimization, and it can make your head spin. But listen, it doesn't have to be that complicated. By the end of this video, you'll have a crystal clear understanding of both mutual funds and the stock market so you can make the best decision for your financial future. Let's do this. First up, let's break down mutual funds. Imagine a big basket, right? But instead of fruit or bread, this basket is filled with different stocks, bonds, and sometimes even real estate. That's essentially what a mutual fund is. A basket of different investments. Now, you buy into this basket by purchasing shares of the mutual fund. And the cool part? Each share represents a tiny piece of all those different investments within the fund. It's like owning a sliver of everything in the basket. But here's the kicker. You're not managing this basket yourself. Nope, you've got a professional fund manager doing the heavy lifting for you. They're the ones researching, buying, and selling those assets within the fund, trying to make it grow over time. Think of them like your personal investment chef, carefully selecting the best ingredients, or in this case investments, for the perfect recipe for, hopefully, financial success. Now let's switch gears and talk about the stock market. Think of it like a giant online marketplace, kind of like Amazon or eBay, but instead of buying shoes or electronics, you're buying and selling pieces of companies, also known as stocks or shares. When you buy a stock, you're essentially becoming a part owner of that company. You're putting your money on the line, betting that the company will grow and become more valuable in the future. And if they do, well, the value of your shares goes up, and you make money. But of course, it works both ways. If the company doesn't perform well, the value of your shares can go down, and you could lose money. This is why doing your research and understanding the businesses you're investing in is absolutely crucial. It's like choosing which horse to bet on at the Kentucky Derby. You don't just pick randomly, you look at their track record, their jockey, their overall potential. Same goes for stocks. You gotta do your due diligence. Chapter 3. Now let's talk risk. Because listen, any investment involves some level of risk. With mutual funds, you're automatically getting diversification because your money is spread across different assets. It's like, instead of putting all your eggs in one basket, you're dividing them among several. This helps to reduce the impact of any one investment performing poorly. Plus, you've got that professional fund manager I mentioned earlier making decisions on your behalf, which can be super helpful, especially if you're new to this whole investing thing. Individual stocks, however, come with a higher risk because your money is concentrated in a single company. If that company tanks, you're potentially looking at some serious losses. But of course, higher risk can also mean higher potential returns. So it's all about finding that balance that you're comfortable with. Chapter 4. Okay, let's be real, the whole point of investing is to make money, right? So let's talk potential returns. Historically, the stock market has delivered higher returns compared to mutual funds over the long term. This is because when you invest in individual stocks, you get the full benefit of that company's growth. Remember, you're a part owner. However, with higher potential returns comes higher risk. Mutual funds, on the other hand, tend to offer more moderate but steadier returns. They're less volatile, meaning they don't fluctuate in value as dramatically as individual stocks can. This makes them a great option for those who are risk-averse, or who are investing for long-term goals like retirement. Chapter 5. Now when it comes to actually investing, both mutual funds and individual stocks have their pros and cons in terms of ease and management. Mutual funds are generally considered more hands-off. You pick a fund that aligns with your investment goals, risk tolerance, and you're pretty much good to go. The fund manager takes care of the rest. This makes them super beginner-friendly. Investing in individual stocks, however, requires a lot more time, research, and active management. You need to stay up to date on market trends, company news, and constantly analyze your portfolio to make sure it's still aligned with your goals. It's definitely more work, but some people actually enjoy the challenge and the thrill of picking their own stocks. So which one is better, mutual funds or the stock market? Well, the answer is, as always, it depends. It depends on your risk tolerance, your investment goals, your time horizon, and how much time and effort you're willing to put in. If you're new to investing or if you prefer a more hands-off approach, mutual funds can be a great option. If you're more experienced and you're willing to put in the work, investing in individual stocks might be a better fit. The most important thing is to do your research, understand the risks and potential rewards of each option, and make an informed decision that aligns with your personal financial goals. Remember, the best investment you can make is in yourself and your financial education.